But I'm excited today to introduce our first guest. Today with me is Tanner Bickelhaupt. He's the founder and CEO of the Tanbic Company. Now, again, he's investing, developing, he's actively looking at deals, full cycle to exit. He's operating, he owns a management company. He understands the money and real estate eyes. He's been successful in multiple asset classes, in different markets, and also through different economic cycles. So, Tanner, welcome in.
Good to be here.
Those were a lot of words.
Man, that was impressive.
I'm going to take a drink. So, how are you?
I'm good.
Yeah.
I'm good. Thanks for having me.
Yeah, so setting this up, so many great conversations that you and I have had, even just getting clarity around how can we bring the best value for these operators. I've got a list here of challenges. We talked about, as people register, they give us an idea of, what's keeping them up at night, where are the gaps in the information that they need. And for the audience, you really have some people with, 5 million with money in motion, capital partners that are looking at multifamily in obvious ways. We understand the asset class as being one that is great to diverse, but in this specific session, we're talking about the protection of capital. The markets are going so good right now. When we first drafted it was protecting investor wealth during market downturns, and so as a good solid investor, you're always looking at what's next, even in a current market. And I guess my first question with you is, when you're looking at protecting investor wealth, even in good and bad market downturns, how important is sort of the investor appetite to, as a syndicator sponsor, to that conversation? Because I imagine it's different for the different.
Yeah, I think there's different tranches. There's some syndicators that have what I would call the get rich. We're trying. I have capital. I want to make more money. I certainly have some of those partners, but the plethora of my partners are how do you grow and preserve my capital with a heavy accent on preserving the capital. So that allows that dictates which type of deals I go after, the type of capital that I'm putting on, where I might be fixing debt, bridge debt, just basically how can I have enough runway, because the things that never happen all the time. Mm-hmm. And as we just went through that, we got to test that theory. I would have rather not had to test the theory, but we were able to cash flow the entire time because we had lower leverage per se, right? So the capital preservation investor is going to be looking at this, and he's willing to give up a few points on return for the security of knowing, hey, your break-even occupancy might be 65%, and this property's been running at 95%, and you're in North Scottsdale, or so. So mm-hmm. Basically taking the risk parameters and shrinking them, and obviously, rewinding 2 years ago, if you were just in the growth capital mode of I'm going to just buy it, yeah, and you have cap rate compression and everything else happens, then you were wildly successful there, and you probably had better investor returns. But for the majority of my partners, we like the appreciation, we like the growth, we like what we can control, but we like the peace of mind of knowing that we're owning really good real estate, it's being operated really well, and we don't have a lot of surprises. Yeah. So what are you seeing right? I mean, everybody, and sometimes, and we'll talk about this later, about how the models, the structures of the syndicate, who benefits along the way, the investment incentives for each player in the market. But what are you seeing right now, I guess, in the growth mode for investors? It's super aggressive. So you have cap rates that are the lowest they've ever been. You have syndicators out there. You have sponsors out there. So I'll call, let's say, the big boys, the publicly traded REITs. So they have this duty and this, they have to place capital. And so what they're looking at is inflation. They're looking at, basically, hey, if I can get what they're underwriting now, sometimes 3% cash on cash return on a core asset, they'll do that because it's the highest rate of return that, you're seeing in the market. So So you have them compressing this. You have people buying C and B class properties. And that's where I get a little bit skittish now, is because you always look at the price per pound. What can you build it for compared to what you're buying for? And right now it's uncomfortably skewed. You're seeing Class B properties, trade for. I know you'll see. You have seen 300,000. There's a couple properties in Scottsdale that are, I would consider Class B that will break 400,000 a unit.
Right.
You could probably rebuild that today for, call it 250,000 a unit. So, but people are buying that, investing because they believe the market is going to grow. We have a huge supply constraint here. We have massive demand. Product is behind. So, from a growth standpoint, you have groups that can literally just buy it. They're going to put some sort of temporary debt on it with the plan to really exit it in a year to 2 years. I haven't been able to get there yet. I mean, I am interested in all of that. Again, that's just not necessarily our model. We know that, we understand that, we actually manage a few of those for folks, and it's gone very well. But that's really just betting on the market and taking less things that we can control.
Yeah. Are you doing anything differently now with the capital stack to preserve?
Yeah, the brokers will tell you it's been, I've cost myself on that. I started locking in debt, 2 years ago, 10-year, with the anticipation that, not that I necessarily thought that rates were going to go up, but I just liked the fixed and that it provided a large fluctuation of cash flow. So I should have perhaps put more bridge debt. I would never even talk about bridge debt, 2 years ago, but the bridge debt terms in that market has changed so much that we do talk about it. Yeah. And if we're looking at a deal right now that might be the play. We feel that there's some low-hanging fruit that we can change some stuff very quickly. We do not want to lock in that long-term debt, but I will lock it in as quickly as possible. So the business plan would not be, hey, take it, flip it. It would be, hey, let's create the value, then go put more debt on it, and we'll keep it and hold it.
And is that something you've considered to be? Is that lender on that piece of it, or is that? I guess you're factoring also the priority of where you fall into that as an investor. That bridge, even the mezzanine lender.
Yeah. So bridge financing. The thing that's appealing for bridge financing, the reason a lot of syndicators will like it, is because it boosts their investor returns. Because if I go put on a Fannie Freddie with today's values, you're probably looking at 65, maybe if you get a really good deal, 75% LTV. Bridge, you can hit 85, so you can just leverage it more. It requires less equity, so there's a bigger pop at the end. If it goes up and if it all goes well, it's appealing. So I really have to believe in the up story to do that. Yeah. And so those deals are still out there. They're just harder to find.
Yeah, and so obviously the obvious question is, coming out of the pandemic and COVID and all that we have had to deal with as not only operators but investors, what was the appetite in the space you're operating for your investors? Were they? So I imagine if you're in a period where you have to transact, right, or you have to recapitalize in that period like that, what were you going through? I guess
we were. All of our debt was fixed. I actually set up an office in one of our. We have a 202 unit deal up here in North Scottsdale. I set up an office in one of the units, and because I needed to be in it, to feel like what was going on, because it was really for the first time in my career where I didn't have a friend or a mentor that could say, hey, this is what I've done. Everybody was like, I don't know. Right. So the biggest, from the investor standpoint, like most, we put our pencils down. We focused on what we had, and then the big topic became rent collections and managing through that. And so I think everyone's come out of that pretty well. Some did it quicker than others. We think that we did it we think that we did it well. So from the investor standpoint, I think we had a lot of investors watching. So we were able to actually we sent quarterly distributions each quarter. We didn't miss a cash flow. Now, we were down 30% 35% on, what the expectations were. But I think a lot of groups, said, hey, we're pausing all distributions. We're going to stockpile cash. And heck, that's a great strategy. I mean, I'd be lying if I said we didn't think about that. But we were sitting on plenty of reserves. So I was looking at this going, if this goes terrible, I think we can outlast most with our cash. And so what we did is we cash flowed, and then we spent that cash on doing capital improvements. So we renegotiated all the contracts, from painting the building, the parking lot, whatever it was. Everybody was nervous, and so that went very well for us. And so then when we came out of this, it allowed us to come out of it, a little faster and a little harder.
Yeah, and I imagine communication during that process super important.
Yeah,
a lot of uncertainty.
You just try to be short and sweet because again, no one knew. It's what I would tell my investors is that we're going to help residents. So if a resident needed help with rent assistance, a program, whatever, 100% we're doing that. The intangible was, and I'm sure lots of people experience this, is you had the renter that just basically said, I'm not going to pay you rent because I don't think I should have to. Yeah. And I have a brand new Camaro sitting out in the parking lot and a brand new PlayStation, and, good luck. And so that was the difficult challenge because how do you, when somebody can lock themselves in and basically say, we hear every story there was. And so that was probably the most uncomfortable part for me through that was, hey, we have these residents that are seeing an opportunity and going to try to take advantage of something. And so we countered that, and basically we started paying residents to leave, which again is just counterintuitive of, hey, you owe $3,000 on your rent, you're behind, you have this new car, you're telling me you can't afford it. Right. Here's $500. Why don't you, if you move out in 2 days, will be great. And then you had because the problem is you had new residents that wanted to come in, that wanted to lease the one bedroom, but you didn't have a one bedroom. So you're basically losing twice. So if you could get $1,500, this resident's taking $1,500 by not paying. This one wants to pay $1,500. Well, I think
happy to do so. Yeah.
Yeah, you're losing $3,000 and you're stuck. So we just communicated our process of the challenges of, hey, here's where we're at in collections. Here's what we're trying to do. Here's what we're helping. Here's the rent programs. And no one had a problem with that. So
what did you learn about not only yourself, but maybe even, this was, when you go into these deals, you're never expecting a storm like that or a scenario like that. Does it give you more confidence knowing like that was the ultimate stress test on the economies of?
I think from an asset class, we have office, we have senior living. I think what it did is it took multifamily, and I think that's why even again you're seeing cap rate compression because multifamily did really well. And it came out of it faster than we anticipated. But for people that had the right structure, it was a pretty good hedge. Where the office building that was a tougher pitch. Right. Senior living was tough because how do you move in a loved one when you don't know, because they have to quarantine and now you can see them for 14. So there was a lot more dynamics where multifamily was nimble. And so I think what that is you've seen a lot more institutional capital lower their return parameters from, hey, we normally had to underwrite to a 5% cash on cash. Let's push it down. Let's get the deal. We think there's appreciation. We can cash flow it. And we get paid to place the capital, like, here you go.
Yeah, and you mentioned reserves. You had reserves that helped out through that process. How important is that now and even moving forward?
Yeah, I do see a lot of deals, where syndicators will send, like, hey, what do you think? And that's probably one of my first go-to is that they're not raising the reserves on the front end. Now, I get it because they're buying deals at a high price. You're trying to hit a certain return parameter for your investor. The more reserves you collect, the lower that lowers that. But what I tell our investors is we're going to over reserve this property. We'll probably hold it for 2 years, and then we'll give it back. So I'm willing to take the lower deal on the front end, but gosh, it allowed us to really when this happened, it allowed us to like double down. Instead of going, We renegotiated all of our marketing contracts.
And I'm sure those partners or vendors were happy. I mean, they're uncertain as much, right? You have a buyer now saying, let's play offense.
I mean, there was a week in May that I remember sitting in the apartment. You know, we had the little table and watching, colleagues around the space walk away from $1 million earnest money check on a property that today has probably gone up 35% since that time if they would have closed it. But you couldn't underwrite, you couldn't do it. And so when you start seeing people walk away from that type of cash, it's hard not to get caught in the wake.
Yeah. And that can affect people too going into the next transaction, right? I mean, all these stories, and we miss out on opportunities, and it affects how we look at the next one.
Right.
People are all trying to make the right move. So we've been talking a little bit about the sort of the protecting wealth and sort of the downside thing or the down markets. What about when things are going well? How can you, or I'll just ask you, how do you protect investor wealth when things are going at what they are right now? I mean, things are moving fast here, even in Scottsdale.
There's a lot you have to pay attention to. You have policy changes, proposed policy changes on a capital gains scenario, which would have an interesting effect on the market. I think if the proposal of the 43% of the capital gains goes through, I think you'll see a lot of multifamily owners literally just pull their product off the market. They'll hold. And so then I think we'll have an even more supply constraint market, which is interesting. Right now, some people will argue, hey, we think it could drive prices down. I personally think the opposite. I think people still want to be in the space. We're just going to have less to buy. Construction hasn't caught up, all of that. What we're also experiencing right now is massive rent growth. And for really no apparent reason, meaning we're not spending capital to force rent. We're literally forcing rent because we're 98% occupied. And you have 2 units left, and it's like, well, let's raise this because we'd like to, as we've talked about, you want your occupancy 92 to 95 is kind of like where we like to play. At 98, 99, 100, you're not charging enough.
Right.
And so you're seeing that go across a lot of portfolios.
That's without the value add stuff. That's
just because.
Yeah.
And so, true story, we went to market a Class B product. This is 3 months ago because in Phoenix, in certain areas, Class B cap rates are trading lower than Class A, which is a fundamental flaw, right? So,
well, that's an early indicator of what?
I mean, I've never seen it before where a mid-80s property is going to trade at a lower cap rate than a Class A because, in theory, Can you
build a new? That would be great. Build a new, and I know Daniel. I talked to Daniel in pre-talk. If you can build a Class B property.
That's right. Yeah, if you could build a Class B, that'd be an interesting business model.
There is technology getting closer to how the construction costs and innovation around that. But
yeah, you just go take all these old doors we're ripping off and start fresh. So these cap rates that were backwards, we thought we were being smart, saying, hey, we'll sell a Class B for, call it a 3.2 cap, and we'll go buy a Class A for a 3.25, and if we're really lucky, maybe a 4 cap in a certain market. Now, what was happening is when we went out to market it, the level of offers that I got spooked me. So these were hard conversations to have with a broker where people are literally coming in and say, here's millions of dollars, non-refundable, day one, sight unseen at X, which is 40% more than we bought it for a year ago.
Yeah.
Now, NOI had grown a little bit on a trailing 3-month trend, but again, the math was, and so you sit there and we were looking at it, and we had 1031 in it, and so the majority of these investors, they always want their capital back, but they're really interested in the cash flow and the quarterly, the quarterly distributions. So if I go and we double their money, that's great. They're going to high five, but then they're going to pay taxes, and then they're going to come and go, okay, I really want the yield because it's just what are we doing?
Meanwhile, the scenario is where you talked about where no one's selling because of the potential policy changes.
Yeah, and so these offers were coming in, and they were so aggressive, and I'm like, I don't know how I'm going to buy. right? Because walking around with 30 million bucks now and say you want to buy a property used to go.
Right.
There's so many guys walking around with so much capital who have 1031 problems because they sold, they pulled the trigger, the clock's ticking. And so you're seeing these offers get super aggressive. Great to sell in, horrible to buy in.
Right.
And meanwhile, what was happening is we sold at what we thought was a really good cap rate. We started to see major rent increases. So fast forward the last 2 months, we've had 50 leases, over 150.
And you could be under contract, and this happened, and it changes the whole perspective.
And I couldn't do it. So what I went back and said, hey, I can't sign the PSA. And the brokers, it's horrible because the brokers did their job, right? Like everybody did their job. They worked their tails off. I got cold feet. Now,
but this is also having clarity over the investment objectives of the capital partners that you have.
Yeah.
As a syndicator, that's the payday, right? I mean,
it's what? Yeah, of course, right? Yeah, I mean, that's when you get the pop. As a syndicator.
Do you need to have the courage to make those sort of? I mean, you're on the front nine in this game, right? So, and I mean that by like you have many years ahead of you in multifamily. Like that's important to the relationship. Your ability to raise new capital. I remember when I said no to, I think it was at the time Arizona's single largest transaction. It would require $50 million of our partners' equity. And I just walked properties, and I'm like, the money's been made here, and we said no to it. And that was back 2007. I'll let you figure the story out there. But saying no, nobody got paid. In fact, I didn't have very many friends internally on the investment committee because there was a lot of the structure of the company was we can manage overhead by transaction fees, and doing deals is how we stay with all these people around us. So it takes some courage to say no to something like that. I mean, that's a.
Well, there's.
How do you? I mean, what do you say to
these
sponsors for that?
I mean, these investors, I have an obligation to grow and give their money back. Period. And it's very simple if you just put the investor first. It's really a simple deal because what happens is I would tell investors, hey, here's the number that we have. This is what that would mean to you. That is fantastic. But I can't help but notice our last 10 leases, we had a $150 rent increase for nothing, because we're full.
Right.
Now, fast forward over the last 2 months, we now have over 50 of those. Well, now you put today's cap rate on a $150 rent increase over 202 units, and you go, okay, wow, there's an extra $6 million, right? But if I would have signed the PSA, I'm locked. So now the buyer, he's like, hey, we're good. We'll wait. We like the asset. They have a lot of capital they need to place. But I don't know if it's going to come together because I'm not going to do it unless I can give the investor options of one, if you want your money back, you can take it and pay the tax. That's sure. They control all of that. If we find where we think that we can literally upgrade the asset from an 80s product to a 2000 product and hit and exceed the cash flow, then we have a compelling story. As long as the location's strong and all of that stuff. So it just, as the sheer interest in this asset, I mean, that's why we bought it. It was refreshing to know that, hey, like everybody else is seeing the value and stuff here. But while the number was great and the number that we would receive in our 1 year exceeded our 6 year pro forma, there's more there. Yeah. And there's more that we can control. And so that's what we're looking around saying, we're getting these rent increases. We're still sitting on $1 million of CapEx dollars of stuff that we can do to make this better.
True, that's a good point.
And if we get stuck with this, my debt's fixed. We're now on a value standpoint based on what the market's telling us value. We're now less than 50% leverage, right? Now, some would argue that's not a good strategy of capital. You have too much equity there. I would agree. But as long as that thing's cash flowing, it lets us come at it from a position of strength. So if we find the right asset, we can make the move. But I didn't want to have, hey, sold it, got the tax thing I got to place it.
Yeah, and we'll talk about that a little bit later in terms of the averages and the track record as like, because you could pop some pretty good IRR returns with something like that.
Right.
All right, so we do have some questions over here. Carrie, I don't, let's see. Okay. Cool. My iPad is a little non-responsive, but So speaking of deals, John shares, where do you find off-market multifamily deals? How are you financing them? How do you unlicensed real estate brokers get paid to sell properties in states where they are not licensed? So that's a compound question, but we can just start with that kind of a market moving, and everyone trying to protect. Even you're in the deals and not putting supply back out on the marketplace. How do you go about finding those off-market deals?
I don't think
such a thing as an off-market
I don't think they
deal?
exist. And was saying that I've sold a deal off market. Now, there's a plethora of reasons why, but if you know who the buyer is, then maybe you can make that decision. So when I sold something off market, like we had this idea of who the buyer was, they showed up, we hit the number, it all works. But right now in this marketplace, with what people are doing, because what I learned on this last project is people are coming in bidding, and they're just trying to outbid who the next guy is, and all of a sudden everybody's taking their eyes off the property because they're just trying to get the deal for all the other reasons. So if you're a seller, sellers are not selling off market today. You're costing yourself massively, and I know
this is a real problem.
Yeah, I mean, I'm saying that because we just closed the transaction, 3 weeks ago that was off market, but we entered off market 3 months ago, and that's how fast the market has literally changed. Because when I sold that, I thought, oh, we'll go find a deal off market, and those are. But if you need to find a deal off market, that's a broker relationship, right? So that's a broker knowing where the equity's at. You're going to take care of them. We tell brokers all the time, if you bring a deal and they don't want to sell or they don't want to pay the commissions, we'll pay the commissions full.
Is that a question that just in terms of the cycles that we're in, maybe sometimes our strategies change from cycle to cycle, but sometimes what we think is how we attack the industry it stays the same.
Yeah.
Like in a market where it's not so favorable, maybe the off market is more of an opportunistic play, but
it's just hard to stick out as a buyer.
Yeah.
I mean, you literally, you can walk around cash. You used to be able to call a broker and say, I have 1031 money, here's whatever, and you're getting 4 deals that week of guys that they have talked to that might be interested. Like, you could literally fish. So I'll tell you, in the last 60 days, we have made probably 25 offers off market. And numbers that I would never, ever conceive. And there was one deal in particular that, you're not supposed to really wanted this one. Super aggressive. The seller was
super aggressive?
Super aggressive. It would have broken the record. It would have been the highest price at the time.
Which nobody wants to do as your space.
No, but at the time, we thought it was a great offer. It was an $80 million offer. And the seller scoffed at us. And you know what? I thought he was crazy, but he's right. Like, he probably just found another $10 million by just waiting another month and a half, and nothing's changed. So we've been writing those offers, and we're a credible group. We can show balance sheets. And we're writing those with non-refundable dollars. Hey, you show us clean title, here's $1 million. Like, it's crazy even. It's not a good fundamental, but that's. Now, there's ways that we mitigate that and the risk as far as being prepared and knowing where we're buying. But finding off market is just really, really difficult unless it's just you have that classic story of somebody doesn't want to go through the marketing process. They don't want to disrupt the staff. They don't want to disrupt the residents. And if that's important to somebody and you can come in and perform, then maybe there's an opportunity. But really, that's a gift, and you should probably buy it if you can find that.
Yeah. Yeah. So let's go back to that capital. So we're in the protection of wealth during really any market turn. What are the questions investors or even passive investors should be asking syndicators, even going into these deals? Like, where am I in this process? Am I, what's my order of things?
Sure.
How do you look at that? What are the questions we should be asking?
Yeah, I mean, I think you see. At least I see a lot of investors that will send different deals that they're looking at. Hey, what's your opinion, whatever. And I don't ever say yes or no on somebody else's deal. I will give a series of questions, right? So, hey, here's some questions I would ask. if you're comfortable with those, then you should definitely proceed or not proceed, or that's up to you. But I do find it interesting oftentimes where the investor's fitting in the capital stack.
Right.
So somebody will come back and go, okay, look, here's this, our track record is X IRR, which that's when we talk about the timing of the money and when they're putting in, how they can kind of shift that. So that's another understanding. But where the investor actually fits in is, you're seeing mezzanine capital. So like lots of guys are having, if they're having troubles raising equity, they're going to have debt. They'll maybe have mezzanine or a preferred equity piece, and then basically you're fourth in line. So, if the thing goes sideways, the lender's going to get paid first, the mezz is going to get paid next, or the pref, and the investor's going to get paid last. And so your price per pound of where you're entering the deal, that's where you need to get, somewhat comfortable. And so a lot of investors aren't necessarily understanding that. They see the return, and they always see the top return, right? So if you say, hey, this is a 6 to 10% return, the investor sees 10, right? And they think, okay, I got 10.
Right.
As you know, it goes.
But they don't know where they fit into the deal.
Right.
In many cases. Or they may not ask that.
Yeah. Or the timing of it.
See the return.
Yeah. Because sometimes, it's all when they place the equity. So lots of these big groups have debt funds, or they can borrow it a different way. And so they can borrow in tranches. And, for us, like, we put the whole capital stack together at once, and we shoved the pile in at once. But if I was putting this pile in here, waiting to put this pile until I need it, then I would have the money less time. And if it goes well, then it boosts the returns.
Yeah. So, as looking at the sponsor sends you a deal, you're looking at these returns, IRR, all that. We'll talk a little bit more about those and how those can be even manipulated in some sorts. But with cap rate compression where it's at now, I mean, operators, the sponsor strength, you'd have to be pretty negligent you mentioned the NOI going up and getting the rents. I mean, you have to really have your eye off the ball as an operator, I think, to, there's not enough market challenges, I think, in place. There's market challenges for sure, but not enough without the things we can't control, like the money, the supply of available other properties. But what are you seeing with, cap rate compression and how that's, I guess, moving the market in your terms, I guess, because can you really control some of these elements? And what you mentioned, how you focused on saying no to an exit because you had more control over what you could control, which was that $150 pop. What's your perspective on the cap rate compression and all the stories of what's happening economically with inflation? And
yeah, I think we're. This might sound bad to say, but I'm least focused on the value in the cap, because it doesn't matter if it goes down or it goes up. I'm focused on the cash flow. So I'm a cash flow investor. So I'm focused on that yield.
Is that important? Is that an important question investors should be asking? I mean, because sometimes it's more the syndicators rewarded less on that, but more on the
Totally.
exits. Yeah.
Totally. I mean, that's where there's the pop and the waterfall and all the stuff where the syndicator, they get, how many deals have people looked at in the last, 5 years that have been long-term hold and were owned over a year, right? And it's, and then how many times have we been talking about what inning were we in the multifamily space? And it's, I'm arguing we're in inning 1, maybe 2. Like we have massive. The fundamentals are really strong. Supply is low. So as far as the cap rate, when I underwrite a deal, the cap rate goes up. So depending on the market, it'll be anywhere from 0.5% to 1%, wrong way direction.
Are you seeing that in is that your strategy? But
that's just me. I'm plenty of guys do that. I do see a lot of deals that, listen, there's a lot of people that have had a lot of success here in the last, if you just bought anything,
right,
it worked, right? And that's cap rate compression. And so as the investor, I think the investor should be looking at, hey, show me what your NOI growth has been. right? Like show me where you created the value. The market hit, people can say, hey, we knew this market was strong, we knew this was good, we predicted that, we got rewarded for that. But last May, when people were walking away from earnest money and whatever, I don't know, what was the cap rate? Nobody really knew. Some people were doing transactions, and I commend them. The financing world changed dramatically, right? Because financing, Fannie and Freddie requiring more reserves. And so all this stuff moves, and it moves very, very fast. But the cap rate, I don't need the cap rate for the exit, because if I'm leveraged correctly and I'm cash flowing correctly, then I don't have to be a seller. So then you're having conversations with the investor of, hey, the market's up, right? Let's say interest rates go up, cap rates go up. The market is not favorable to sell, but here's your quarterly check. Right?
And if you hang on long enough, technically cash flow increases because debt's being paid down, right? And there's good alignment, I think, in the way that you're structuring those transactions. But I like what you said. You don't need that cap rate in order to sell. That's powerful. And I know that it can be complex because you're talking about development costs earlier. Right. If you can build it for less than you can buy it, then
you can't all day.
Yeah.
I mean, that's now.
But there's different risks
and
in doing that whole journey, right? I mean,
yeah, but it's still, that's probably what I focus on the most right now. I mean, I put an offer out yesterday, and where I'm not going to get the deal, where somebody is going to outbid me, is I'm like, I literally have land right across the street. I can build it for $70,000 less a door with today's cost. Now, it's going to take me 3 years, right? And there's a whole different level of risk and stuff associated with that, but it's just that old school fundamental, replacement cost, and stuff is very, very, very expensive. But the builders will tell you, lumber's been the big talk. That's costs have always gone up. I'm more concerned about, can the vendors get the supplies, right? Can we get the refrigerators?
True.
Can we get the widgets, to put the piece together? Because if I'm buying the land right, and I have the right contractors, and I have all that stuff can work out. But I don't want to be caught with all of a sudden having some of this stuff that I bought for X that's now worth significantly less, and now you have to ride it through a cycle or what have you. But rent growth is projected to be very, very strong moving forward, at least in the Phoenix area. I think guys are experiencing that portfolio wide, and so that will solve a lot of price per pound, price per door issues that people might have.
And so you have capital, like you've done a great job of tracking that. Obviously, doing good for business helps. But these same capital partners are seeing deals come across their table as much. Hey, 8% return, and here's the IRR, and they're calling you, and you're saying, look, I'm trying to still find something. I'm working on this, right? And so maybe you don't have anything for them, and that's a sign of good stewardship in that you're not just buying anything. And we used to say the best service we provided was the real estate we didn't buy.
Right.
And so how do you manage through that, going to these relationships that you have that are elite capital, and being able to say, you're just looking for just the right deal? I mean, maybe deal flow could be a challenge for somebody.
I mean, I had a family office not that long ago. We were in dialogue over a project I was chasing, and he's like, hey, I need to hit X, and I need this IRR, and I need this multiple, and I need this yield on cash. And I'm like, that does not exist for this type of asset class. Like it does. The industry's too smart, right? There's too many players. There's too many, now, unless you're buying it from an uncle, right? There's some whatever, there's too much capital. And so I think that, these groups that have these, these parameters, if they're seeing these parameters, you just got a simple question. how and why?
How do I fit into the deal?
Yeah, like
what has been your
how are you getting
growth?
a 10% cash on cash?
Right.
Like, how does that exist? Like year one, oh, you're going to raise rents $250. Great. You're going to spend $2 million in capex, and you're going to maintain 99% occupancy while you're doing all that.
Right.
Oh, there's right. Like that's the if you're going to spend this much capex, you're going to disrupt the rest of the residents. Right. They're going to move. Your occupancy is going to go down. Your cash on cash probably won't be 10. It could happen. Probably not. Right. Like people are like, that doesn't work. So it's really just kind of understanding these assumptions as these investors or these people have these parameters. So I'll have investors tell me all the time, I'm looking for X. Well, you don't understand the market. That was 2 years ago. Like that deal doesn't exist. And if I put that in front of you, you should be skeptical. Mm-hmm. You should literally be skeptical.
But they're asking you because they're seeing other, deals come across their desk?
Right. So if you look at like a REIT today, they're probably underwriting between a 10 to 12% IRR. Mm-hmm. That's a there's marginal rent growth, so if they're willing to buy at a 10 to 12% IRR, mm-hmm. and I'm a seller, I'm probably selling to them, right? Because they come up, they show the balance sheet, they show the funds, they have a surety to close. So guys for like me, that's where it gets difficult, is competing with those, is that, you're like, hey, here's the track record, here's what we're going to buy. So if we're buying institutional quality assets, then you're going to pay institutional quality prices and have. Now, I think we can beat the institutional returns because of the way that we run and things that we do. But from the buy side, like you have to make very similar projections.